There's a version of this story where Adam Neumann becomes one of the greatest entrepreneurs of his generation. And honestly, for a while, it really looked like that was exactly what was happening. By early 2019, WeWork had ballooned into a $47 billion company, bigger than the combined market cap of most hotel chains, most airlines, and a lot of actual real estate companies. SoftBank had written checks most people couldn't even fathom. Celebrities were talking about it. MBAs wanted to work there. And Neumann himself was on the covers of magazines, being held up as the next Steve Jobs. But here's the thing about a story that sounds too good. Sometimes it is. What happened next wasn't just a bad quarter or a rough patch. It was a full, spectacular unraveling. And when it was over, WeWork had gone from $47 billion to almost nothing in the span of a few months. This is how it happened. New York skyline, WeWork interiors, investor meetings, stock screens. The original idea wasn't crazy, not even close. The late 2000s had left a lot of people in a strange position. Freelancers, small startups, early-stage companies, all needing real, professional office space, but with none of the leverage to actually get it. Long leases, big deposits, furniture you had to buy yourself. It was a headache. Adam Neumann looked at that problem and saw an opportunity. WeWork would sign the long leases, handle the build-outs, and then rent that space back in smaller chunks, with flexibility. Month to month, short-term, all-inclusive. It was Airbnb logic applied to offices, and early on, it genuinely worked. But Neumann wasn't content to build a real estate business. He wanted something bigger than that. He talked about elevating the world's consciousness. He said WeWork wasn't just a company. It was a physical social network, a community, a movement. That's where things started to get complicated. Co-working spaces, entrepreneurs collaborating, networking moments. For a few years, the numbers looked great, if you didn't look too hard. WeWork was opening locations everywhere. New York, London, Tokyo, Mumbai. If you walked into one of their spaces, they were genuinely impressive. Beautiful design, great coffee, a buzzing atmosphere. It felt like the future of work, and Neumann had a gift for making you believe in it. Investors were lining up. SoftBank, led by Masayoshi Son, became WeWork's biggest backer, eventually pouring in close to $18 billion. The logic, at the time, seemed almost reasonable. Winner-take-all markets reward the fastest mover, so burn cash now and dominate later. It was the same playbook that had worked for Amazon, for Uber, for a dozen others. With each new funding round, the valuation climbed. $5 billion, $10 billion, $20 billion, then $47 billion. Nobody was asking the hard questions yet. That came later. Global expansion, funding headlines, VC meetings, office launches. Here's the part of the story that gets glossed over, but it's arguably the most important part. Even at its peak, WeWork had a structural problem that no amount of good design or charismatic pitching could fix. The business model was built on a fundamental mismatch. They were signing 10, 15, even 20-year leases on office space, and then renting it back to customers on terms as short as a month. Think about what that means. The moment a recession hits, the moment companies start cutting costs and canceling office subscriptions, WeWork would still be on the hook for billions in long-term lease obligations. The risk hadn't gone away. It had just been hidden inside the company's balance sheet. In 2018, WeWork lost $1.9 billion on $1.8 billion in revenue. They were spending more money than they were making, by a lot, and the gap wasn't closing. None of this was secret exactly, but as long as private investors kept writing checks, the company didn't have to explain itself to anyone. Read financial charts, lease documents, empty desks. In August 2019, WeWork filed its SC1, the document you have to publish when you're going public. And that's when everything fell apart. The S1 was supposed to be a victory lap. Instead, it read like a confession. The losses were staggering. The governance structure gave Neumann almost unchecked control. His shares carried 10 times the voting power of regular shares. There were related party transactions that raised serious questions, including one where WeWork had paid Neumann $5.9 million to license the word "we" back from a company he personally owned. Public market investors, unlike the private backers who'd funded the company for years, are not known for their patience with this kind of thing. The reaction was swift and brutal. analysts tore the filing apart. The valuation that had once hit $47 billion was revised down to $20 billion, then $15 billion, then lower still. The IPO, which WeWork desperately needed to fund its operations, was in serious jeopardy. Within weeks, it was clear the offering couldn't go forward. Not at any number that made sense. IPO filings, headlines, boardroom tension. In September 2019, the IPO was formally withdrawn. A few weeks later, Adam Neumann resigned as CEO, walking away with a package reportedly worth around $1.7 billion, which, depending on your perspective, is either a remarkable exit or a remarkable indictment of how the whole thing was structured. SoftBank, having already bet enormous sums on WeWork, stepped in with a rescue package to keep the lights on. The alternative was bankruptcy, which would have been even messier. Then came the layoffs. Nearly 2,400 employees lost their jobs in one round alone. The community WeWork had spent years building, the brand, the culture, the carefully curated vibe, started to feel hollow pretty fast when people realized the company had been running out of money the whole time. WeWork did survive, in a reduced form. It eventually went public through a SPAC deal in 2021. But the story had fundamentally changed. Empty offices, employee exits, press coverage. I think the reason WeWork's story still gets talked about, still gets dissected in business schools and podcasts and documentaries, is that it wasn't really about office space. It was about how much we want to believe. Neumann was a genuinely compelling figure. He could walk into a room and make you feel like you were witnessing the beginning of something important. SoftBank's Masayoshi Son famously said he decided to invest $4.4 billion in WeWork after a 28-minute meeting. 28 minutes. That's not due diligence. That's a spell. And it worked. For a while. Because the story was good. The spaces looked great. The energy was real. But none of that changes the math. And eventually, with a company burning through billions of dollars a year, the math is all that matters. The lesson isn't that vision is bad, or that ambition is dangerous. The lesson is simpler than that. A story, no matter how good, is not a business model. At some point, every company has to answer one question. Can you make more money than you spend? WeWork couldn't answer that question. And in the end, that's the only number that mattered. Open the video description for links below. Subscribe, like, and share for more stories. Check the pinned comment for resources. If you enjoy stories about billion-dollar successes, spectacular failures, and the business decisions that changed entire industries, subscribe to the channel and turn on notifications so you never miss an episode.